Want to know the secret behind Warren Buffett's fortune? Today, we break down Buffett's two-step stock market strategy, how to identify a wonderful business, buy at the right price, and build lasting wealth. There's a quiet office in Omaha, Nebraska, far from the glittering towers of Wall Street, where one of the greatest investors of all time sits at his desk each morning. Warren Buffett doesn't use multiple computer screens showing real-time stock prices. He doesn't employ complex algorithms or chase the latest market trends. Instead, he reads, he thinks, and he waits. Over decades, this approach has turned him into one of the wealthiest people on earth, not through luck or insider secrets, but through a remarkably simple two-step strategy that anyone can understand and apply. Imagine for a moment that you're standing in front of two doors. Behind the first door is a room filled with noise, flashing lights, and people shouting about the next big thing. Everyone is moving fast, buying and selling, trying to time the perfect moment. Behind the second door is a quiet library filled with annual reports, business books, and the financial statements of companies that have been around for decades. Most people rush through the first door. Warren Buffett walks calmly through the second. And that choice, that fundamental difference in approach, explains everything about his success. The beauty of Buffett's strategy isn't just that it works. It's that it works because it's built on principles that never change. While technology evolves and markets fluctuate and new investment products emerge every year, the core truths about what makes a business valuable remain constant. A great company generates cash, treats its shareholders well, has competitive advantages that protect it from rivals, and is run by people who care about more than just their own compensation. These facts were true 100 years ago, they're true today, and they'll be true 100 years from now. Before we dive into the two steps themselves, let's understand why Buffett's approach differs so dramatically from what most people do in the stock market. When you ask the average person how to make money in stocks, they'll probably talk about buying low and selling high. They'll mention timing the market, watching for trends, or following hot tips. Some might reference technical analysis, chart patterns, or momentum indicators. These approaches aren't necessarily wrong, but they're incredibly difficult to execute consistently. They require you to outsmart millions of other investors who are trying to do the exact same thing. They turn investing into a game of predicting what other people will do, rather than focusing on the actual value of the businesses you're buying. Warren Buffett took a different path from the very beginning. As a young man in his 20s, he encountered the writings of Benjamin Graham, a professor at Columbia Business School who would become known as the father of value investing. Graham taught that a stock isn't just a ticker symbol that goes up and down. It represents ownership in a real business with real assets, real earnings, and real value. When the market price of that stock falls below its intrinsic value, that creates an opportunity, not because you're predicting the stock will bounce back tomorrow or next week, but because you're buying something worth more than you're paying for it. This insight transformed Buffett's life. He realized that successful investing wasn't about being smarter than everyone else or having access to better information. It was about being patient, disciplined, and rational in situations where other people were being impatient, undisciplined, and emotional. It was about understanding businesses deeply and only investing when the price made sense. It was about treating stocks as pieces of businesses rather than pieces of paper to be traded. So what are these two steps that have guided Buffett for more than 6 decades? They sound almost too simple when you first hear them. Step 1 is to find wonderful businesses. Step 2 is to buy them at sensible prices. That's it. No complex formulas, no secret indicators, no need to predict next quarter's GDP growth or the Federal Reserve's next move. Just find great companies and don't overpay for them. Of course, the simplicity of the concept doesn't mean it's easy to execute. Each of these steps requires knowledge, judgment, and discipline. But that's what makes them powerful. They're simple enough to understand and remember, but deep enough to guide you through every market condition imaginable. Let's start with step 1, finding wonderful businesses. This is where most investors get it wrong. From the very beginning, they don't really look for wonderful businesses. They look for stocks that might go up. They scan lists of the biggest gainers from yesterday. They read articles about which sectors are hot right now. They listen to podcasts where people discuss their favorite picks for the next month. None of this is about finding wonderful businesses. It's about finding popular traits. When Buffett talks about a wonderful business, he means something specific. He's looking for companies with durable competitive advantages, what he calls economic moats. Think about a medieval castle surrounded by a moat filled with water. That moat protects the castle from invaders. In business terms, an economic moat protects a company from competitors who want to steal its customers and profits. The wider and deeper the moat, the safer the business, and the more likely it is to generate strong returns for many years into the future. What creates these moats? Sometimes it's a powerful brand that customers trust and love. Think about Coca-Cola, one of Buffett's most famous investments. People don't just buy Coca-Cola because it's a brown fizzy drink. They buy it because of what the brand represents, the memories associated with it, the consistent taste they can count on anywhere in the world. That brand took more than a century to build. A competitor can't just spend a few $1 million on advertising and replicate it. The brand itself is the moat. Sometimes the moat comes from network effects, where the value of the product increases as more people use it. Consider American Express, another longtime Buffett holding. The more merchants accept American Express cards, the more valuable those cards become to consumers. The more consumers have American Express cards, the more merchants want to accept them. This creates a reinforcing cycle that's very difficult for competitors to break into. You can't just start a new credit card company and expect to compete with American Express overnight. Even if you have plenty of capital, the network is already established. Other times, the moat is built on cost advantages. If a company can produce something more cheaply than its competitors, it can either charge lower prices and win on volume, or charge the same prices and enjoy higher profit margins. Walmart built its empire on this principle. Through economies of scale, sophisticated logistics, and ruthless efficiency, Walmart can offer lower prices than smaller retailers. This attracts more customers, which allows even greater economies of scale, which enables even lower prices. The cycle reinforces itself, and competitors struggle to match it. Then there are switching costs, situations where it's expensive or difficult for customers to change to a competitor's product. Buffett loves businesses like this. Think about the software that runs a company's accounting system or the database that stores all its customer information. Switching to a different provider isn't just a matter of price. It requires retraining employees, converting data, risking downtime, and potentially dealing with compatibility issues. Even if a competitor offers a slightly better or cheaper product, the hassle of switching often isn't worth it. This gives the incumbent company pricing power and customer loyalty that can last for decades. Finally, some modes come from regulatory advantages or licenses that limit competition. If you need a government permit to operate in a certain industry, and those permits are difficult to obtain, then the companies that already have them enjoy protection from new entrants. Buffett has invested in businesses ranging from utilities to railroads to insurance companies that benefit from various forms of regulatory protection. The key insight here is that wonderful businesses aren't just companies making a lot of money. Right now, plenty of companies have one great year or ride a temporary trend. What makes a business wonderful is its ability to keep making money year after year, even when competitors try to take its customers, even when the economy weakens, even when new technologies emerge. That sustainability comes from having real competitive advantages that protect the business over time. But identifying the moat is only part of understanding a wonderful business. Buffett also looks at the quality of management. This matters enormously because even a company with strong competitive advantages can be mismanaged. The people running the business need to allocate capital wisely, treat shareholders fairly, and make decisions that strengthen the company for the long term rather than just boosting short-term results. How do you evaluate management quality? Start by looking at their track record. Have they successfully grown the business over many years? Have they been honest with shareholders, especially when things went wrong? Do they own a significant amount of stock themselves, aligning their interests with yours? Are they paid reasonably, or are they extracting excessive compensation through stock options and bonuses? Do they talk about return on equity and long-term value creation, or do they obsess over quarterly earnings targets and stock price movements? Buffett tells a story that illustrates this perfectly. He looked for managers who behave as if they're running the business for their own family's benefit, not just managing it as employees. When a manager owns a substantial piece of the company and treats every dollar of shareholder money as if it were their own, they make better decisions. They don't waste money on fancy headquarters or corporate jets. They don't overpay for acquisitions just to make the company bigger. They don't diversify into businesses they don't understand just because it seems fashionable. They focus on doing what they do best and returning excess cash to shareholders when they can't find good uses for it within the business. Another element of a wonderful business is the simplicity and understandability of what it does. Buffett has famously avoided investing in technology companies for most of his career, not because he thinks technology is unimportant, but because he doesn't feel he can reliably predict which technology companies will still be dominant in 10 or 20 years. The tech industry changes too rapidly. Products that seem unbeatable today can become obsolete tomorrow. That doesn't mean technology companies can't be great investments, but it means they fall outside Buffett's circle of competence. This concept of circle of competence is crucial. It means knowing what you know and, just as importantly, knowing what you don't know. If you can't explain how a company makes money in simple terms, if you can't understand its competitive position, if you can't predict with reasonable confidence what it will look like in a decade, then it doesn't matter how popular the stock is or how much everyone else is talking about it. It's not within your circle of competence, and you shouldn't invest in it. Buffett loves businesses he can understand easily. Insurance companies that collect premiums and invest the money before paying claims. Railroads that move goods across the country more efficiently than trucks. Banks that take deposits and make loans. Food and beverage companies that sell products people consume every day. These businesses aren't exotic or exciting, but they're predictable. You can look at them and have a reasonable idea of what they'll be doing 5 or 10 years from now. That predictability is valuable because it allows you to estimate the company's future cash flows, which is essential for determining what it's actually worth. Speaking of cash flows, this brings us to another characteristic of wonderful businesses. They generate more cash than they need to maintain their operations. Think about what this means. The company brings in revenue from customers, pays all its expenses including employee salaries and raw materials, invests in maintaining and growing its operations, and still has money left over. This excess cash can be returned to shareholders through dividends or stock buybacks, or it can be reinvested in new opportunities that generate even more cash in the future. Companies that don't generate free cash flow are much riskier investments. They might show accounting profits on their income statement, but if all that money gets consumed by the need to buy more equipment, build more stores, or fund working capital, then shareholders never see any benefit. You're essentially hoping that someday in the future the company will get to the point where it generates cash you can actually access. That's speculation, not investing. When Buffett looks at a company's financial statements, he pays special attention to return on equity, which measures how much profit the company generates relative to the shareholders' investment in the business. A company with a high return on equity is creating value efficiently. It doesn't need massive amounts of capital to grow. It can reinvest its earnings at attractive rates, creating a compounding effect that builds wealth over time. Compare this to a company with a low return on equity that needs to constantly raise more money from shareholders to fund its operations. In the first case, your investment grows naturally through the business's own success. In the second case, your ownership gets diluted as more shares are issued. Now here's something that surprises many people when they first study Buffett's approach. He's not looking for companies that are growing at incredible rates. Rapid growth is nice if you can find it in a wonderful business, but it's not the primary criterion. In fact, extremely fast growth can sometimes be a red flag. It might indicate that the company is in a hot industry that will attract lots of competition, which could erode those attractive returns over time. Or it might mean the company is sacrificing quality or financial stability to chase expansion. Buffett prefers steady, sustainable growth in a business with strong fundamentals over spectacular but unsustainable growth in a shaky business. Let me share a story that illustrates this principle. Imagine 2 lemonade stands in your neighborhood. The first stand is run by a kid who's constantly expanding, opening new locations every month, offering dozens of different flavors and spending heavily on advertising. Sales are growing quickly, but the kid is also spending everything he makes and borrowing more money to fund the expansion. The second stand is run by a kid who has one great location, makes the best lemonade in town, charges a fair price, and generates steady profits year after year. Which stand would you rather own a piece of? The flashy one with uncertain sustainability, or the steady one with proven economics? Most investors would chase the first stand because the story is more exciting. Buffett would buy the second one because the business is better. Over time, that boring lemonade stand will likely create more wealth for its owner than the rapidly expanding but financially stretched operation. This patient, disciplined focus on business quality over growth rates is one of the things that sets Buffett apart. Finding these wonderful businesses requires work. You can't just screen for stocks with low price-to-earnings ratios or high dividend yields and expect to find them. You need to read. You need to understand industries. You need to study financial statements and annual reports. You need to think about what gives each company its competitive advantage and whether that advantage is sustainable. This takes time and effort, which is why most investors don't do it. They want shortcuts and formulas and quick answers. But there are no shortcuts to finding truly wonderful businesses. You have to put in the work. The good news is that once you understand what to look for, you start seeing these patterns everywhere. You begin to recognize when a company has real pricing power versus when it's just benefiting from a temporary trend. You can distinguish between genuine innovation that creates lasting value and hype that will fade. You develop an intuition for what makes, say, business durable. And here's the best part. You don't need to analyze every company in the market. Buffett himself has said that an investor only needs to find a few truly wonderful businesses in their lifetime. If you can identify just a handful of great companies and invest in them when the price is right, you can build substantial wealth. This brings us naturally to step 2 of Buffett's strategy. Buy these wonderful businesses at sensible prices. This is where the discipline comes in, and it's the step where even investors who successfully identify great companies often fail. They fall in love with a business and convince themselves that they should buy it regardless of the price, or they see the stock price rising and fear missing out, so they chase it higher, or they watch a wonderful business whose stock is expensive and tell themselves they'll buy when it gets cheaper, but when it finally does get cheaper, they get scared and don't pull the trigger. Price matters enormously in investing, even when you're buying wonderful businesses. If you pay too much for a great company, your returns will disappoint. If you pay a sensible price, your returns can be exceptional. And if you're fortunate enough to buy during one of those rare moments when a wonderful business is genuinely cheap, you can generate the kinds of returns that seem almost magical. To understand why price matters so much, think about investing as buying a stream of future cash flows. When you buy a share of stock, you're purchasing the right to your proportional share of all the money that company will generate for shareholders over its remaining life. The question is, how much should you pay today for that stream of future cash? Obviously, you want to pay less than it's worth. But how do you figure out what it's worth? This is where the concept of intrinsic value comes in. Intrinsic value is what a business is actually worth based on the cash it will generate in the future, discounted back to today's dollar. It's not the same as the current stock price, which reflects what other investors are willing to pay right now based on their emotions, expectations, and guesses about the future. The stock price can be higher or lower than intrinsic value, and it's in those gaps that opportunities emerge. Calculating intrinsic value precisely is impossible. It requires predicting the future, which no one can do with certainty. But you can make reasonable estimates based on a company's track record, its competitive position, and your understanding of its business model. Buffett talks about looking for opportunities where the value is so obvious that you don't need to be precise. You want a margin of safety, a gap between the price and the value that's large enough to protect you even if your estimates aren't perfect. Here's a simple way to think about it. Imagine you're considering buying a rental property. You'd look at how much rent it generates each year, subtract the costs of maintenance and taxes, and figure out what kind of annual return you'd earn on your investment. If the property costs, say, $1 million and generates $100,000 a year in net cash flow, that's a 10% return. You then decide whether 10% is attractive enough based on the risks involved and the alternative uses for your money. Buying a stock should work the same way. You estimate the cash the business will generate for you as a shareholder, compare that to the price you'd have to pay, and determine whether the implied return is attractive. The challenge is that businesses are more complex than rental properties. Their cash flows can vary from year to year based on economic conditions, competition, and management decisions. They might grow over time, or they might shrink. They might pay out cash to shareholders through dividends, or they might reinvest everything back into the business. All of this uncertainty makes it harder to calculate value precisely, which is why Buffett insists on that margin of safety. Let's walk through a practical example. Suppose you find a wonderful business that consistently generates $1 billion a year in free cash flow. It has strong competitive advantages, excellent management, and a predictable business model. You believe this company will likely maintain or grow its cash flows for many years to come. How much should you pay for it? If the entire company is valued in the stock market at $10 billion, you're paying 10 times its annual cash flow. That means if the business never grew but maintained its current level of cash generation, it would take 10 years to earn back your initial investment. Is that attractive? Well, it depends on your alternatives and your confidence in the business. If you can earn 5% per year in safe government bonds, that's a 20-year payback period. 10 years looks pretty good by comparison. Plus, if the business grows its cash flows over time, your actual returns will be much better than that simple calculation suggests. Now, suppose the stock market gets enthusiastic about this company and values it at $50 billion. Suddenly, you're paying 50 times the annual cash flow. Even if the business maintains its cash generation, it would take 50 years to earn back your investment. Even worse, if the business grows its cash flows by 5% per year, which is pretty good performance, might still take 20 or 30 years before you've earned an adequate return on what you paid. That's not a sensible price, even for a wonderful business. This example illustrates a critical point. When stock prices get very high relative to a company's cash generation ability, future returns suffer. It doesn't matter how great the business is. If you overpay, you will regret it. This is why Buffett is willing to hold cash and wait, sometimes for years, until opportunities emerge at sensible prices. He'd rather do nothing than overpay for even the best businesses. So when do sensible prices appear? Usually during one of three situations. The first is when the overall stock market declines. When investors get pessimistic about the economy or worried about some external event, they sell stocks across the board. Good businesses and bad businesses alike see their prices drop. This creates opportunities because the intrinsic value of great companies doesn't change just because investors are temporarily worried. If you have cash available and the courage to invest when others are fearful, you can buy wonderful businesses at prices that seem absurd in retrospect. Buffett's greatest purchases often came during market panics. He bought Washington Post stock during the recession and market decline of the early 1970s. He invested heavily in American companies during the financial crisis of 2008 and 9. In both cases, the businesses he bought were fundamentally sound, but fear had driven prices to levels where the cash flows you'd receive as a shareholder offered enormous returns relative to what you paid. Those who had the discipline to wait for those moments and the courage to act when they arrived generated wealth that compounded beautifully in the years that followed. The second situation when sensible prices emerge is when a specific wonderful business encounters a temporary problem that doesn't impair its long-term economics but does scare investors. Maybe the company missed a quarterly earnings target. Maybe one of its products faced a recall. Maybe a key executive left the company. Maybe the industry went through a tough year. None of these issues necessarily change the company's competitive advantages or its ability to generate cash over the next decade, but they can cause the stock price to drop significantly as short-term oriented investors bail out. Buffett loves these situations because they're where the gap between price and value becomes most obvious. Everyone else is focusing on the negative headline, but he's focused on whether the business's moat remains intact. If the competitive advantages are still there, if the management is still capable, if the long-term cash generation ability hasn't been impaired, then a lower stock price is a gift. It's an opportunity to buy a wonderful business at a sensible or even cheap price. Consider what happened with American Express in the 1960s. The company got caught up in a scandal involving salad oil fraud that had nothing to do with its core credit card. And travelers check businesses. The stock price plummeted as investors worried about the company's reputation and potential liabilities. Buffett looked past the scandal and focused on the fundamentals. Were people still using American Express cards? Yes. Did the company still have its valuable network and brand? Yes. Were the legal liabilities likely to destroy the business? No. He invested heavily, and as the scandal faded and the business continued to prosper, his investment multiplied many times over. These temporary problems are actually ideal opportunities because they create the margin of safety Buffett seeks. You're buying a wonderful business whose long-term prospects remain strong, but you're paying a price that reflects short-term difficulties. As time passes and the temporary issue resolves, the stock price typically recovers to reflect the company's true value, and you benefit from both the company's cash generation and the revaluation of the stock. The third situation, when sensible prices appear, is actually the most common, though it requires the most patience. It's when a wonderful business simply trades at a reasonable valuation relative to its cash flows and growth prospects, not because anything dramatic happened, but just because the market isn't currently excited about it. The stock might sit at the same price for months or even years while the business quietly generates cash and strengthens its position. Eventually, the market notices and the price adjusts upward, but in the meantime, you're able to accumulate shares at prices that will look like bargains in the future. This is how Buffett built his position in Coca-Cola in the late 1980s. The stock wasn't cheap by traditional metrics, but relative to the company's growth prospects, brand value, and global expansion potential, the price was sensible. He bought steadily, and over the following decades, Coca-Cola generated enormous returns for his investors. The key was recognizing that a sensible price for a wonderful business can still lead to excellent results if you're patient, and let the business compound its value over time. Understanding sensible prices also means understanding what you're willing to walk away from. Buffett has passed on countless investments over the years because the price wasn't right. He watched the technology bubble of the late 90s without participating. He sat out much of the bull market of the past decade. He's held enormous amounts of cash while waiting for opportunities. This discipline to do nothing when prices don't make sense is just as important as the courage to act when they do. Many investors struggle with this patience. They feel like they need to be doing something, buying something, taking advantage of something. The market is always offering opportunities, always showing stocks that are moving, always presenting stories that sound compelling. But Buffett understands that most of the time, the right action is no action at all. Wait for the pitches that are right in your sweet spot. Don't swing at everything just because it's coming across the plate. There's a famous analogy Buffett uses about baseball. In regular baseball, you have to swing at pitches in the strike zone or you'll strike out. But in investing, there are no called strikes. You can watch pitch after pitch go by, waiting for the perfect one, and nobody will call you out. You can wait for months or years until exactly the right opportunity presents itself at exactly the right price, and then you can swing hard. This ability to be selective, to wait for high probability opportunities with asymmetric risk-reward ratios, is a huge advantage that most investors fail to exploit because they can't tolerate the boredom of waiting. Now let's talk about what happens after you buy a wonderful business at a sensible price. This is where Buffett's approach differs even more dramatically from typical investing advice. Most people think about when to sell almost as soon as they buy. They set target prices or stop losses or decide they'll hold for a certain period. Buffett's approach is different. His favorite holding period is forever. This sounds like an exaggeration, but it's not. When Buffett buys a wonderful business at a sensible price, he genuinely plans to hold it indefinitely. He's not looking to trade his way to wealth. He's looking to own pieces of great businesses that will compound in value over decades. The longer you can hold a wonderful business, the more time compounding has to work its magic, and the more your wealth grows without you having to do anything. Think about what compounding really means. If you own a business that generates a 15% return on equity and reinvests all its earnings back into the business at that same rate, your wealth grows by 15% per year. After 10 years, you haven't just made 150%. You've made roughly 300% because each year's gains compound on top of all the previous year's gains. After 20 years, you're up more than tenfold. After 30 years, you're up more than 50-fold. That's the power of compounding, and it only works if you stay invested and let time do its job. Every time you sell a wonderful business and buy another one, you interrupt this compounding process. You pay taxes on your gains, you incur transaction costs, and you take the risk that your new investment won't be as good as the one you sold. Most importantly, you give up time. Even if your new investment is slightly better than your old one, the time lost in the transition can outweigh the benefit of the switch. This is why Buffett holds companies like Coca-Cola and American Express for decades. The businesses keep compounding value, and he keeps benefiting from it without doing anything. Of course, there are situations where selling makes sense. If a wonderful business stops being wonderful, if its competitive advantages erode, if management deteriorates, then holding on just because you've held for a long time would be foolish. Similarly, if the stock price becomes so extraordinarily overvalued that it's clearly pricing in decades of perfect execution, you might reasonably decide to sell and wait for a better entry point or deploy that capital elsewhere. But these should be rare exceptions, not the rule. The default approach for a wonderful business, bought at a sensible price, should be to hold and let it compound. This long-term orientation has another benefit that's less obvious but equally important. It dramatically reduces the emotional stress of investing. If you're constantly worrying about when to sell, watching the stock price every day, reacting to quarterly earnings reports and analyst opinions, investing becomes exhausting and anxiety-inducing. But if you've done your homework up front, if you've bought a wonderful business at a sensible price, and if you're committed to holding for the long term, then short-term price fluctuations become irrelevant. You can ignore the noise and focus on whether the business continues to perform as expected. Buffett has described his ideal investment as one where he could buy the stock and then have the market close for 10 years. Would he still be happy owning it after a decade without being able to check the price? If yes, then it's probably a good investment. If no, if he'd be anxious about not knowing the price or worried about what might happen, then he probably shouldn't buy it in the first place. This thought experiment cuts through so much of the complexity and noise that surrounds investing and gets to the heart of what matters. Are you buying a piece of a business you'd be happy to own for a very long time? Let me share another story that illustrates this principle beautifully. In the 1980s, Buffett began buying stock in a company called Capital Cities Communications, which owned television stations and newspapers. He paid what seemed like high prices at the time, and many observers questioned the wisdom of investing so heavily in traditional media. But Buffett understood the economics of local television stations and the quality of the management team. He held his investment through multiple market cycles, through the rise of cable television, through technological changes that disrupted the media industry. Decades later, when Disney acquired Capital Cities, Buffett's investment had multiplied many times over. The key wasn't timing or trading. It was identifying a wonderful business, paying a sensible price, and holding for the very long term while the business compounded value. Now, you might be wondering how to actually implement this strategy in your own investing. Where do you start? How do you find these wonderful businesses? How do you determine what price is sensible? Let's walk through a practical framework you can use. Start by making a list of businesses you already understand. What products do you use? What services do you pay for? What companies do you interact with regularly? These are often the best places to begin your research because you already have firsthand knowledge of their products, their customer relationships, and their position in the market. You don't need to analyze every company in the stock market. Focus on the ones where you have some natural advantage in understanding the business. Once you have your list, start reading. Find the company's annual reports and read them carefully. These documents are freely available on company websites and provide a wealth of information about the business model, competitive position, financial performance, and management's thinking. Pay special attention to the letter from a CEO. How do they talk about the business? Are they honest about challenges? Do they focus on long-term value creation or short-term targets? Do they explain their strategies clearly, or do they hide behind jargon and buzzwords? Next, study the financial statements. Don't be intimidated by the numbers. You're looking for patterns over time, not trying to become an accountant. Look at revenue and earnings over the past 5 or 10 years. Are they growing consistently? Are profit margins stable or expanding? How much debt does the company carry relative to its earnings? How much free cash flow does it generate? Is the company reinvesting in the business or returning cash to shareholders through dividends and buybacks? As you study these numbers, you'll start to get a feel for whether this is a wonderful business. Does it generate high returns on equity? Does it produce more cash than it needs? Are the financials stable and predictable, or do they swing wildly from year to year? Is the company's debt manageable, or does it seem over-leveraged and risky? These questions don't have precise cutoffs, but wonderful businesses tend to score well across all these dimensions. Once you've identified a potentially wonderful business, the next step is understanding its competitive advantages. What protects this company from competitors? Is it a strong brand? Network effects? Cost advantages? High switching costs? Regulatory protection? Try to articulate in your own words why customers choose this company over alternatives and whether that advantage seems durable. If you can't clearly explain the moat, you probably shouldn't invest because you don't really understand what makes the business special. Research the industry and competitive landscape. Who are the main competitors? How has market share evolved over time? Are new competitors emerging, or is the industry relatively stable? What technological or regulatory changes might impact the business? You're not trying to predict the future perfectly, but you want to understand the major risks and opportunities facing the company. Now comes the hardest part, determining a sensible price. There's no single right way to do this, but here's a straightforward approach. Look at the company's free cash flow, which is the cash generated from operations minus the capital expenditures needed to maintain the business. This represents the money available to shareholders. Now divide the current market value of the company by that free cash flow number. This gives you the free cash flow multiple similar to a price-to-earnings ratio, but often more meaningful because it's based on actual cash rather than accounting earnings. Compare this multiple to the company's historical averages and to other similar businesses. If the company typically trades at a free cash flow multiple of 15 and it's currently trading at 10, that might indicate an attractive entry point. especially if nothing fundamental has changed. About the business. If it's trading at 30 when it usually trades at 15, you might want to wait for a better price, even if you love the business. Another useful exercise is to think about what return you'd expect based on the current price. If the company generates steady free cash flow and you buy at a price that implies a 10% free cash flow yield, meaning the annual free cash flow is 10% of what you're paying, then you can expect roughly a 10% annual return if the business maintains its current performance. If the business grows over time, your returns will be higher. If it shrinks, they'll be lower. Does that potential return justify the risks involved? Is it better than your alternatives? These questions help you think about price in terms of expected returns rather than trying to predict where the stock price will be next year. Here's a crucial point that often gets overlooked. The process of finding wonderful businesses and determining sensible prices takes time and work. You can't rush it. You might spend weeks or months studying a company before you feel confident enough to invest. You might study 10 companies and only find one or two that meet your criteria at prices you're willing to pay. This is normal and expected. Quality investing isn't about volume. It's about selectivity. Buffett himself has said that if you have a 20-hole punch card for your entire investing lifetime, and every time you made an investment you had to punch a hole, you'd make much better investment decisions. That constraint would force you to be selective and thoughtful. While you don't literally have such a limitation, adopting that mindset helps. Act as if you can. Only make a limited number of investments in your life. This naturally leads you toward wonderful businesses at sensible prices rather than mediocre opportunities that happen to be available right now. Another aspect of implementation is position sizing. When you find a wonderful business at a sensible price, how much should you invest? Buffett's approach has been to make concentrated bets. He doesn't believe in excessive diversification. His reasoning is straightforward. If you've done your homework properly, if you really understand a business and are confident in its prospects, then you should invest a meaningful amount. If you learned something today, subscribe for more strategies, tips, and insights into wealth building and investing like Buffett.